Hey everyone, today I want to talk to you about a refinance, a home equity loan, and a home equity line of credit, and what the differences are, and which is the best product for me. I'm Ruben Davis, propertybyruben.com, PLG Estates in the greater Los Angeles area. So, most people know what a refinance is. A refinance is basically taking your current mortgage and refinancing at the current prevailing rate. Now, there's two reasons why you would do that. Number one, it would be to re-amortize your loan over a longer period. So let's say you had a 30-year loan and you paid down 10 years and you want to re-amortize it back to another 30 years, so stretching those payments back out so you have a lower payment. The problem is that you'll be paying for that mortgage for over 40 years, and the hundreds of thousands of dollars worth of mortgage interest that you would have paid on that loan is significant. And I can work the numbers for you if you need that information. Now, it would only make sense to refinance, a straight refinance for the current amount if the interest rate is lower. So let's say you got a $500,000 loan 10 years ago at 7.5%, and today's rates are 4%. It might make sense for you to lower that interest rate by refinancing to the 4% interest rate. But does it make sense to take cash out? It depends. If the interest rate is lower and it makes sense and the dollar amount is lower, then yes. But if the interest rate is higher, then it doesn't make sense. So let's say you already have a 4% interest rate on your mortgage and you're going to refinance to take $100,000 out, and in doing so, you're going to take a 6.5%. The other options are a home equity loan. A home equity loan is basically an installment loan or a second loan against your property at a higher interest rate. Basically, you'd have a first mortgage and a second mortgage. Again, is it the best product for you? It depends on where your interest rate is and how much savings you're getting. Let's say that same $500,000 loan that you got years ago is only at a 2% interest rate, and the current prevailing rate is 7%. Would it make sense for you to be able to take a refinance and take the 7% for a total of $600,000? No, it's probably better for you to keep the 2% $500,000 loan and then take the $100,000 at the higher rate. That way you're only paying high interest on the $100,000 amount. Now, the better option would actually be a home equity line of credit. Home equity loans and home equity line of credits are cheaper alternatives to being able to get money out of your property. The reason why I like home equity line of credit is because you could be able to use it to leverage the equity in your home for anything that you absolutely need. In typical cases with my clients and my investors, they use it for building cash flow through rental or income properties or upgrading their current property for a sale. So, for example, let's say you have that same $500,000 loan amount at a 2% interest rate. Current prevailing rate is 6%. You don't want to refinance the extra $100,000 and have a total of $600,000 at 6%. So what you would do is you'd keep your loan at $500,000 for 2%, and then you take the second home equity line of credit. What a home equity line of credit is a bank account or a credit card against your home. So let's say you took that same $100,000. The beautiful thing about it is you do not have to take the full $100,000 out. You just have it available to you whenever you need it. So let's say you want to remodel that kitchen, it's going to cost you $30,000. Then you would just run up the home equity line of credit to the $30,000 and then pay that down. When you pay it down, that same $100,000 is available to you all over again. So it would make sense for you to get a home equity line of credit to be able to utilize it for leverage against your home. Now, with it, they're usually interest only for 5 to 10 years. So it just depends on which bank you're getting the product from. So by being able to make just the interest only payment, it really ends up being significantly less, and you can refinance the total amount at a later time when rates go down. It is at an an adjustable interest, so you do have to be aware of that. But in my particular case, in the trainings that I do, I don't care what the interest is because I can teach you how to pay down debt, pay down things faster, and be able to access the equity in your home. So if that's something that you might be interested in, please PM me, DM me, call me, email me, whatever it is that you need to get a hold of me, and I can help you decide which product is best for you. And that's the difference between refinances, home equity loans, and home equity line of credit. Make it a great day.